Welcome back to Digital Rage. I'm Jeff, the producer here at Fish Tank Digital. We are a cybersecurity marketing company, and we have an article today about ABM, why mid-level cybersecurity vendors should adopt our strategy of an ABM playbook instead of going full-on into an ABM strategy that may not pay off. Let's check it out.
Okay, so if you are a marketing leader at a mid-market cybersecurity firm, and I mean, especially if you're in that, $1 to $5 million revenue spot, I'm guessing you feel the pressure.
Oh, yeah.
You bought into the whole vision of account-based marketing. You're probably invested in a pretty high-end ABM stack, and now you're just staring at these six-figure software bills, a thin pipeline, and this really frustrating realization that the whole system just isn't built for your scale.
That frustration is, it's completely justified. We've been digging into source material that really hits this exact crisis point. And the core thesis is sharp. It's uncompromising, really.
Which is?
Traditional ABM is fundamentally broken for the mid-market vendor. It just demands a budget you don't have. And maybe more importantly, it forces you to go after accounts where you have almost zero chance of winning against the big guys.
Okay, let's unpack this then, because the sources we've looked at, they don't just give us the diagnosis. They offer a completely new playbook.
Right.
So our mission for this deep dive is to get a quick handle on why that old, expensive, diluted model fails.
Yeah.
And then pull out the four foundational pillars of this efficient alternative, a framework they're calling structured account selling.
And we really need to make a fundamental pivot here. It's about shifting from that expensive dilution, trying to be everywhere for everyone, to really focused, results-driven execution. But before we get to the solution, we have to hammer home the reality of the problem.
The diagnosis.
Exactly. The three core reasons why trying to copy the enterprise ABM playbook will always fail a smaller, leaner cybersecurity vendor.
Let's start with the math then. That's the first thing that really breaks the strategy. You just can't fight a budget war with the giants.
Yeah.
So tell us, why is the financial side of ABM so flawed for a company in the mid-market?
It's purely a matter of scale and opportunity costs. A really functional enterprise ABM stack, and we're talking the software, the data licenses, the whole platform, that can easily cost $250,000 annually.
Yeah.
And that is before you run a single ad campaign or hire anyone to manage it. So if you're, say, a $3 million company, committing that much cash to an unproven strategy, it forces you to gut your other channels.
So you're forced to starve the things that are actually working.
Exactly. You are sacrificing reliable, scalable channels like SEO, organic content, or heck, even hiring 2 dedicated SDRs, all for a stack that promises these huge, distant enterprise deals. You're trading, reliable sustenance for a lottery ticket.
And you can't afford to wait years for that ticket to pay off in the mid-market.
Not a chance.
So that's just the cost of entry.
Yeah.
Once you're in, you hit reason number 2, which is you're basically advertising into this massive void of skepticism. What does the sheer density of the cybersecurity market do to your precious display ads?
It just turns them into noise. The person you're trying to reach, that CISO, the VP of IT, the head of engineering, is utterly besieged. Yeah. They are targeted by literally hundreds of security vendors every week. So when your lean team runs some generic display ad about, proactive threat intelligence, it just lands in a sea of identical promises. It talks about features, but it fails to build the one thing you absolutely need to sell complex security products.
And that is trust.
That is trust. And without it, they're not going to click. And they're definitely not scheduling a meeting.
Okay, so you spend a ton of money on a tool. The tool generates really low-value engagement, and that leads us right to the third failure point, which the source material calls alignment theater. This is where the internal pain really starts, isn't it?
It's the worst kind of corporate choreography. Alignment theater is what happens when marketing and sales agree to share the same list of target accounts, but that list is the only thing they actually share. They have no real coordinated plan on how to engage those accounts in a human way.
So marketing is over here cheering, hey, we hit our click-through goal on 5 accounts.
Yeah.
But sales is looking at that and saying, these leads are garbage.
Precisely. Marketing is optimizing for platform metrics clicks, time on site, some arbitrary account score. Sales is optimizing for meetings and revenue. So when those clicks don't turn into qualified conversations, you just get finger pointing.
Of course.
Marketing says sales isn't following up fast enough, and sales claims marketing is just feeding them cold contacts. It looks great on a slide in the quarterly report, but in practice, it's just shared disappointment and, frankly, mutual resentment.
That paints a very vivid and I think a very painful picture. So if the traditional model is too expensive, too noisy, and it's too disjointed, we need to completely shift the philosophy. Let's move away from that diluted approach and get into this framework built for focus, structured account selling, or SaaS.
The whole philosophy of SaaS is built on a really elegant truth, and it's that precision beats budget every single time. So instead of trying to broadly target 500 accounts that all the major players are also chasing, you leverage your smaller size. It becomes an advantage. Yes, agility. You become surgical. You deploy personalized resources that a big, sluggish enterprise just cannot match.
And that surgical approach, it has to start with the target list.
Yeah.
What the sources call the golden 50.
Yeah.
Why is this hard limit of 50 accounts so important? I mean, why isn't 500 better?
Because a list of 500 targets, as the source material puts it, is dilution, not strategy. When you're resource constrained, you just can't afford to spread your precious content creation, your SDR's time, and your limited ad spend across that many targets. The golden 50, it forces discipline. These have to be accounts where you have a legitimate, provable right to win.
A right to win, meaning your solution solves a specific acute pain they're feeling right now.
Right now, exactly.
And to create that, let's call it a sacred list, you need a pretty rigorous scoring system to avoid just wishful thinking. The research lays out a specific 4-part system. Can you walk us through those percentages? Because it feels like this scorecard is the backbone of the whole thing.
It is. You have to use a firm scorecard to get the emotion out of it. So 30% of the score is based on a perfect ICP, ideal customer profile fit. You know, they have the budget, the size, the right industry.
Got it.
Another 30% is for a technographic match.
Okay, let's pause there. For anyone who might be newer to that term, a technographic match, just to be clear, that means verifying they already use a specific complementary technology, right? Like they're all in on AWS, or they run a specific competitor's tool, which makes your solution a perfect plug-in.
Exactly right. It's their technical fingerprint. If your product is purpose-built to integrate with a specific cloud provider, those accounts get the points. They're pre-qualified for a technical fit, which makes the sale that much easier.
Okay, so that's 60%.
Then 20% comes from recent active intent signals. So they're actually out there researching solutions in your space. And the final 20% is for strategic value. Is this a potential lighthouse account? Could this one win open up an entire new segment for you? If an account doesn't score high across all 4 of those criteria, it just doesn't make the golden 50, period.
That really ensures every dollar and every minute is hyper-focused. Okay, so we've established the who. Now, pillar 2 is about the when. We're told to hunt for signals, not just clicks. Why are the 4 trigger events you identified so much better than the general intent signals that these expensive ABM tools are tracking?
Because those general signals, someone reading a competitor's blog post, that often just means they're kicking the tires or general education. They don't signal budget availability.
Or a real reason to change.
Exactly. Or imminent organizational upheaval. We're hunting for signals that force a decision now.
This is where we stop chasing generalized research and start looking for real structural change. So what are those 4 crucial high-value trigger events?
So the 4 events that are immediate indicators of pain or, budget release. Number 1, new funding rounds.
Fresh cash.
Fresh cash and aggressive scaling needs, which means their security architecture probably hasn't kept up. Number 2, a new CISO or a new head of engineering is hired. That new leader has a mandate for change and a clean slate for vendors. Number 3 is a tech stack announcement. Say they publicly announce a big migration to a new platform.
Which creates new holes.
It inadvertently creates a new vulnerability you're perfectly positioned to solve.
And the 4th one, which I imagine is often hard to monitor, is a competitor's very public failure. A big breach, a massive outage, something that makes the incumbent vendor look really bad.
That is the golden moment. If a competitor has a highly visible security incident, your target account is actively reviewing their own risk profile that day. These 4 signals are the moments your coordinated team should drop everything and act.
But wait, I have to ask, how can a mid-market team really monitor that stuff effectively? A competitor's failure or a new CISO hire? Doesn't that still require expensive social listening tools, kind of recreating the budget problem we just talked about?
That's a great question. And the beauty of the Golden 50 list is that it's actually manageable for manual observation. You don't need a 6-figure listening tool. You assign 1 owner per account, an SDR or an account executive, and they use simple tools: LinkedIn monitoring, Google Alerts, industry news feeds. It's intelligence gathering, not platform purchasing.
So you're trading software spend for disciplined human effort.
That's it. You're reframing the cost structure entirely.
Okay, so we know who and we know when. Pillar 3 is about the budget shift. So where does all the money that was going to those broad ABM ads go now?
It goes directly into creating problem-specific content. This is the new fuel for your engine. And the key rule here, which has to be sacred for your content team, is simple. Do not write about your product features. Write exclusively about the account's specific acute pain.
That distinction is huge, especially in security where the pain is so complex it could be regulatory, risk-based, a bottleneck in their pipeline. Give us the deep dive on that specific content example from the source.
Okay, let's use that example again. If one of your Golden 50 is a high-growth fintech firm, their biggest, most urgent problem is probably regulatory.
Compliance.
Right. Scaling fast while staying compliant. So your content shouldn't be a white paper on the future of cloud security. It needs to be titled, precisely, Meeting GLBA Compliance in Azure During Rapid Growth. A checklist for $100 million fintechs.
It's hyper-relevant. You can't not click that if that's you.
It is. That single asset demonstrates your depth. It solves their immediate problem before they even know your product exists, and it becomes the single best sales tool you have. It establishes you as a consultant and authority right away.
That leads us perfectly into Pillar 4, execution. Once a trigger event happens and you have that problem-specific content ready, the sequence has to be human-led. We have to avoid that feeling of a mass email blast.
Absolutely. The goal is consultation, not bombardment. And this requires a coordinated multi-channel 5-touch sequence. And it's led by the sales owner assigned to that specific account. Crucially, because your SDRs are only focused on 50 accounts, they actually have the bandwidth to personalize these touches dramatically.
So walk us through those 5 steps. How does the sequence feel consultative and not, aggressive?
Okay, touch 1. A highly personalized email from the sales lead. It references the specific trigger you just saw. Hey, saw the news about your new CISO, congrats. And it immediately offers that problem-solving content asset.
The tailored one.
The tailored one. Touch 2, almost right after, is a LinkedIn connection request from that same person, but it includes a relevant comment about something they posted, not just a generic request.
So the multi-channel approach kicks in within the first day. What about touch 3, the physical channel?
Touch 3 is so critical because it breaks through all the digital noise. You send a useful physical item.
Not junk swag.
No, not junk, something custom and relevant. For that fintech CISO, it could be a small, high-value book on scaling compliance, or maybe a professionally designed, laminated security risk checklist for their specific cloud environment.
Physical relevance, that's a huge differentiator.
It is. Touch 4 shares a relevant case study, but it has to be narrowly tailored. Not just any case study. It has to show a company of a similar size in their same sector that overcame the exact pain point you identified. It builds that psychological proof.
And then finally, touch 5, the direct contact that closes the loop.
Great. Touch 5 is the direct phone call. But the key is that the call references all the insights, the content, the physical item that you've already shared. You're not calling cold asking for 5 minutes. You're calling to follow up on a personalized consultation that you've already started.
That level of orchestration, marketing, building the precise content, sales, executing this highly personal sequence, it's the total opposite of alignment theater. But it requires real discipline. So what does this all mean for a marketing leader who wants to implement this? What's the immediate action plan?
The research lays out a clear 5-step action plan to get this going next quarter. First, and I know this is painful, you have to pause any broad ABM ad campaigns. They're just budget sinkholes right now. Second, you have to hold that Golden 50 workshop within 2 weeks. Get that list built with precision now.
Third, assign those owners right away.
Absolutely. Every single account on that list needs an owner responsible for signal monitoring and for the execution we just talked about. Fourth, audit your existing content against the needs of those 50 accounts and fill one key gap immediately with a problem-specific asset. And fifth, launch your first 2 SaaS sequences based on the highest value triggers you've already found.
And if we're shifting away from vanity metrics like clicks and MQLs, what are the new critical metrics that actually measure the success of this structured account selling?
The focus has to shift to depth and quality of execution. So you track the account engagement score, not just clicks, but how deep is their interaction with your problem-specific content. You track your signal-to-meeting conversion. How often does a trigger event actually turn into a meaningful high-level meeting?
Okay.
And most critically, you track pipeline generated per target account. If your golden 50 is working, those 50 accounts should be driving a totally disproportionate share of your pipeline. That reflects the efficiency of your focus.
This is a complete paradigm shift for a mid-market firm. I mean, you look at the giants in the cybersecurity space, and they can just throw money at the problem, right?
Okay.
Carpet bombing the market with generic display ads.
And that is the essential insight. You cannot outspend the giants. If you try to play their game, you will lose. But you know what you can do? Agility beats budget every single time. Structured account selling turns your smaller size, your leaner ops, your nimbleness into your greatest competitive advantage. Precision, personalization, and disciplined focus, that's the only way to break through the noise in the mid-market today.
That's the power move. Stop funding a broken model that was built for $100 billion companies and start leveraging your own nimbleness. Now, for one final thought to leave you with, based on all of this signal hunting, you know the 4 high-value trigger events we talked about, the ones that signal an account is in play: new funding, a new CSO, a tech stack vulnerability, or a competitor failing.
So think about your current target list, even if it's just a theoretical golden 50 in your head right now. Which one of those 4 signal types, funding, a new hire, a tech stack change, or competitor failure, which one would immediately generate the highest strategic value, the highest quality lead for your organization specifically?
Identifying that single highest value signal is the very first step toward achieving this critical focus. We'll leave you to chew on that answer until the next deep dive.
Reach out to us at jbyer.com for comments and questions. Follow us at Byer Company on social media, and if you'd be so kind, please rate and review us in your podcast app.